Well, I can envision the comments coming already. Why are you so negative, Matt? The stock market had a great day today. Why are you so doom and gloom? Why is the title of the video, the description of the video, so negative when everything is fine again, right? And you'd be right to the extent that the stock market, U.S. stock market had a great day today. I say great day relative to what it's been doing over the past, several weeks. Dow Jones finished up 674 points today, 1.66%. S&P finished up 117 points. That was 2.15%. And the NASDAQ finished up 457 points, 2.61%. So, on the day, if you just encapsulate this one day, markets had a good day, okay? And those of you in the market that got back some of your paper losses from yesterday, it's fantastic. 10-year bond was up 4 basis points as of recording the video at 4.32%. So money apparently was moving from the bond market back into the stock market, right? Because people were selling bonds, and therefore the 10-year rate moved up a little bit. Gold and silver, market's not closed yet on gold and silver, but they pretty much held their own today. I think gold dropped about $6 an ounce, silver a few cents, nothing major. Cryptocurrencies kind of still moving in concert with the overall stock market, put on some gains, right? So you say, well, why aren't you positive about that? I'm positive for it on the day. But if you look at what the market has lost over the past 2-3 weeks, today's little bounce back, I call it a little bounce back, is just that. Okay. So the question is, what will the catalyst be, or what is the catalyst? Love to hear your thoughts and comments. And is there a catalyst for there to be any follow through, let's say, buying of stocks into next week? Okay, and I guess that's more of a question that I'd love to hear all of your input and your feedback. And I say that because there's an article from CNBC that came out right around the close today that I want to share with you. And if there's a catalyst for stocks moving up, CNBC will be the first one to jump on it. And this article says Dow bounces 500 points as comeback rally from the week's steep losses gains steam. Now, this was a few minutes before the close, actually 15 minutes before the close, and so it obviously didn't finish up higher than that, finished up 674 on the Dow. But let me share with you this story. It says stocks rallied Friday, clawing back some of the steep losses seen this week as investors got a reprieve from tariff-related headlines. It says big tech shares that were rattled earlier this week saw a sharp recovery on Friday. NVIDIA shares popped more than 4%. Tesla and Meta platforms gained more than 1%, along with Netflix, Amazon, and Apple. Great, right? It says stocks bounced, and listen to this. And this is what I want to highlight for you from this article and get your thoughts. Stocks bounced after a lack of new headlines out of the White House related to tariffs, easing concerns around escalating tensions for the time being. Investors might also be scooping up shares after a stock market pullback on Thursday. So according to CNBC, right, the biggest cheerleader of the market out there, stocks rallied today based upon a lack of new headlines out of the White House. There are some headlines, and I'll get to in a second, they're not good. And again, I pose the question, what is the catalyst going to be, if any, for follow-through buying of this market next week? We hear the terms, a dead cat bounce. Again, I'm not an expert. I'm putting this out there and love to hear your thoughts, comments, and get your input. But as of today, all it took for the markets to rally, yes, things don't go down in a straight line. We know that, yes, you could say the markets were oversold, on the shorter term basis. But all it takes, at least today, was a lack of disastrous headlines out of the White House, which, according to CNBC, fueled this buying spree in the markets. There are headlines, though, and let me discuss them with you. Not doom and gloom, just reality. This is out of CNBC as well. Consumer sentiment drops in March to 57.9, according to the University of Michigan survey. Worse than expected. Consumer sentiment took another hit in March as worries intensified over inflation and a slumping stock market, according to the University of Michigan's latest sentiment survey released Friday. The survey posted a mid-month reading of 57.9. This represents a 10.5% decline from February, okay, in the last 30 days, and was below the Dow Jones consensus estimate for a 63.2 reading. Listen to this, the reading was 27.1% below a year ago, okay? That is a massive decline in consumer sentiment. It says, while the current conditions index fell a less severe 3.3%, the expectations measure for the future was off 15.3% on a monthly basis and 30% from the same period in 2024. In addition, fears grew over where inflation is headed as President Trump institutes tariffs against U.S. trading partners. It says, though, and here's a bit of silver lining, okay? I like this. It says the one-year outlook spiked to 4.9%, up 0.6 percentage points, up 0.6 percentage point from February, and the highest reading since November of 2022. That's good news, right? I'm not being sarcastic. I think that's actually good news. At the 5-year horizon, the outlook jumped to 3.9%, up 0.4 percentage points for the highest level since February of 1993. So look at this, tends to support the position or the belief of consumers that at the 1-year horizon and at the 5-year horizon, things are going to be better than they are right now. Okay, and to some extent, that is what the administration's been saying over the past couple of weeks, is that we've got to go through some pain, which will also be felt by the stock market, to kind of get to the other side where we can start rebuilding. Again, I'm just saying that's what's been put out there. Everyone's going to have an opinion, and you know what they say, everyone's got an opinion, right? So you guys are all welcome to leave your thoughts, comments, opinions as to what I just kind of discussed with you. The last article I want to share, again out of CNBC, and this is another headline from an article today. It says consumers are starting to crack. Recession concerns. So I don't think consumers are just starting to crack. I think consumers have cracked. We've discussed on many shows, credit lines are tapped out. Credit card delinquencies are on the rise. Consumers are falling behind 30, 60, 90 on credit card payments, on their home equity lines of credit payments, on auto loan payments. We know that. That's out there. It's factual. Go Google it, look it up for yourself. But this article, again, the CNBC, this is a CNBC story that closed today, again, said lack of headlines was the reason why the stock market rallied today. And these are some CNBC headlines as well. And this is not good. But again, going back to the markets, you got to expect there has to be some days where you're going to get a bounce. And the reason for the title today, for the thumbnail, is not so fast. When you see what and you look at this stuff, again, we have to question what's the follow-through catalyst. Okay, where's it going to come from? So it's not just Walmart. Leaders of companies that serve everyone from penny-pinching grocery shoppers to first-class travelers are seeing cracks in demand, a shift after resilient consumers propped up the U.S. economy for years despite prolonged inflation. Right? We know it was propped up on debt. On top of high interest rates, and I say debt, government debt and consumer debt. This is on top of high interest rates and persistent inflation. CEOs are now grappling with how to handle new hurdles like on-again, off-again tariffs, mass government layoffs, and worsening consumer sentiment. Across earnings calls and investor presentations in recent weeks, retailers and other consumer-facing businesses warned. Okay, companies that have already spent the last year calling out uncertain consumer dynamics are sounding even more worried, according to the article. Quote, our customers continue to report that their financial situation has worsened over the last year as they've been negatively impacted by ongoing inflation. Many of our customers report they only have enough money for basic essentials, with some noting that they have had to sacrifice even on the necessities. And I did a video a few days ago on that, and how I think the title was People Are Hurting. If you haven't seen that, I appreciate you guys going back, take a look at that. Let me know what you think. It says the CEO of Dollar General, Todd Vasos, said on the company's fourth quarter earnings call, adding that customers are expecting value and convenience more than ever. As we enter 2025, he says, we are not anticipating improvement in the macro environment, particularly for our core customer. And again, who are the core customers of Dollar General? Okay, middle and lower income folks, okay, that are struggling, as this guy says, the CEO, even with paying for basic necessities. Elsewhere, it says in the retail industry, American Eagle on Tuesday warned that cold weather led to a slower than expected start to the first quarter, but said it wasn't just the temperatures. The apparel retailer specifically called out less robust demand and said it's taking steps to reduce expenses and manage inventory as it braces for what is still to come. Consumers have the fear of the unknown. He says, not just tariffs, not just inflation, we see the government cutting people off. They don't know how that's going to affect them. They see programs being cut. They don't know how that's going to affect them either, said CEO Jay Schottenstein. And when people don't know what they don't know, they get very conservative. It makes everyone a little nervous. So there were headlines today. The stock market chose to ignore the headlines because there needed to be, from my layperson perspective, needed to be a bit of a bounce towards the end of this week here, since it's all just been a massive, massive sell-off. But again, when you have markets pick up, Dow picked up 1.6%, S&P 2.1%, NASDAQ 2.6%. But don't forget, those markets have dropped a lot more than that. I say markets. Those stocks in the Dow, the S&P, and NASDAQ have fallen way more than that over the past couple of weeks, okay? 10% on the S&P in the last 16 days, as well as the NASDAQ, right? So, and the Russell 2000 I shared yesterday has had a drawdown of 20% from its high. So I'll leave it there today. Going into the weekend, hope you guys have some plans. Going to do something to reduce some stress, maybe spend some time with family, maybe get a walk in, do some exercise, and let's see how next week, and let's see what happens over the weekend. Headlines always get kicked out over the weekend when the markets are unable to react, and then when you see the Monday morning open, you have a catalyst sometimes to the upside or downside. So I'll leave it there today. Appreciate all you guys watching these videos, supporting the channel. It's doing well. I'm very, very grateful and thankful. I try to review and respond. I do review and I try to respond to as many comments as I can. So again, thank you guys very much for hitting that subscribe button. Have an awesome weekend. I'll hopefully be able to chime in Saturday or Sunday, and I'll talk to you soon. Bye.